to the time that the market delivered the CPI number, drops down, creates a short-term low. Notice it's gravitating towards that fair value gap, dropping down into there and then consolidating, and then once more diving down here. And what time of day is that? 9:50. So I teach that usually there's something that goes on in the marketplace that all the buying and selling agrees within that 20-minute time window. Somehow, some shape or form, some unknown influence comes over all the retail and commercial and institutional trading. They all want to buy and sell in that 20-minute interval. It just seems that all that has to happen right then and there. It's uncanny how it happens. It's probably not an algorithm. It's probably just a pure, unadulterated buying and selling pressure that everybody comes to the same conclusion at 10 minutes to 10 to 10 minutes after 10. It's funny how that works. But if we look at how price reacts there and trades up, you have an inversion fair value gap in here between this candle's low and this candle's high. You can see it trades up, comes back down in, and then accumulates, trades into a propulsion block, which is this down closed candle. The order block's here, propulsion block's here. Look at month 4's content on the 2016 mentorship playlist, and you'll know what a propulsion block is. And it rallies and creates a fair value gap here. Consequent encroachments trade there, rallies up, trades to the low of that shaded pink area, which is that what? Remember that daily chart? I showed you that big range in pink. This is the low of that range. So it's drawing back up into that higher time frame array. It's going to treat it as what? A premium array. They create relative highs, relative equal highs. They bump it, trade it back down into what? First presented fair value gap. All of this consolidation, I'm avoiding all that. And then in here, I told my private mentorship students, I said, note the low of the imbalance, the CIBI on the daily chart, and then note the 538 level. And I'm going to be waiting for a displacement inside that shaded area in the direction of 20,538. There's that displacement right here. And then here, I'm accumulating long position, and I'm going to be targeting that 482.75 level. Put a limit order just around that area and try to gravitate towards that with price. I don't need it to trade to 20,490, and I don't need it to trade to 20,538. And because I shared my target yesterday, I told everybody on Twitter the chances of it going to 20,538 now is unlikely in the morning, so don't look for that target to be met. It wasn't met yesterday. So the target, I'm sorry, not the target, the high of yesterday came in at 20,503. And then meandering around the rest of the day. And then now today, this is yesterday's first presented fair value gap. And you can see the reaction off of it here. It's probably random. So notice the high here and here. That's where buy side, minor buy side, running from here to here. So finally, we're going to go down into the 15-second chart. And you can see, remember there was a 1 minute inversion fair value gap on this decline here. But I'm drawing your attention to, after trading down into the 5-minute fair value gap, taking the sell side here, and that Tuesday's premium consequent encroachment wick, which is not appearing on here, I apologize, but just go back at the previous video portions and you'll see it. We're doing your chart, which is really what you're supposed to be doing, because if you do that, you'll have a better view. So right in here, you'll see that we have relative equal highs. So we already know what they've engineered there. Then we have the low of that daily CIBI, and then we have the 482.75 level, which is my draw. That was from my trade. That was my turn list. So I want to aim for that price. And in here, if we add the executions, I'm just going to hover over top the arrows because it'll tell you the price. Because when I put the indentations like this, it just gets in the way and makes it hard for me to point to certain things. So I just want to let you see it for a second. There they are. But I'm going to take them off and just hover over top of the arrows because it's going to accomplish the same thing, okay? So right here in this drop on a 15-second time frame, you can see, look right here on that blue line. I'm hitting the low of that fair value gap on the 5-minute chart. You see it? That's the price right there. Right there. I'm hammering it there, going long. And then this buy side and balance, sell side inefficiency, as it's dropping down, I already know what I'm looking for. We have a breaker. A low, high, lower low. That's your breaker right here. That's why it digs down below half of that fair value gap there, because the breaker's candlestick is a little bit, let me make it wider so you can see it. Now I know some of you are already saying this is really complicated. Well, I mean, if you want high degree precision, it's not going to come with an RSI or a stochastic or MACD. I mean, you're going to have to put some real study into it. But this range here, watch what happens when I highlight that and carry it there, because this is your breaker. Upper half, it's respecting it. Does it go down to consequent encroachment? No. So it's okay for it to trade down in the upper half of this. That's reasonable. You want to see it stay away from the lower half. And at the same time it's doing that, the buying and selling pressure that I like to tell you is going on, it stops it in consequent encroachment. Here, the bodies never come down and lay over top it or go below it. The wicks are allowed to do the damage because you have to look at why the wicks are being permitted to do the damage. It's digging into some other liquidity, or it's digging into another close proximity array, like this breaker here. So you can see my entry there, inside of the breaker, in its upper half, and then it rallies, and then I'm adding inside of this gap here, and then I'm looking for a partial here, and then it's trading down into the first presented fair value gap there. And there's 5 sold here, and then I closed the trade out manually because my wife required my attention and I couldn't manage the trade the rest of the time. I was being distracted with her. Later on in the day, here's that first presented fair value gap again and again. And here we had the displacement. I told my private membership students, you cannot join that. You cannot join my Telegram channels that have my user groups. You cannot do that. Stop asking. There is not going to be a future paid mentorship. I don't do this a lot. We basically just talk and casually talk. We rarely ever do anything that would want to draw more attention to you wanting to join it. Okay, so it's just a way for me to have a private community where I can go out and talk to them and not have to explain everything in detail what I just said. So I'm mentoring here. This is the mentorship right here. I'm talking about it live and teaching it for free. So, all right. So in here, I'm using the inefficiency here, and then the inversion fair value gap here. So I'm accumulating all of these positions in here because I know that it's not coming back down to the low. It's not doing that. So all of this is this and this. I'm trading all the trades in there, knowing that I have already seen the accumulation required before getting up into that shaded pink area, which is that daily civvy. So accumulating it in here, waiting for a nice rally higher. Once it breaks this high here, it should be no problem for it to trade to my objectives. Above the high, it drops down. It sucks people into thinking it's going to go short. They ride one more time higher, buy side, dropping deep into this inefficiency and order block. And then rallies again. Accumulates around that quadrant in the civvy on the daily chart, and then trades to my objective right there, 20,488, which is less than what? The 20,490 level, but greater than the 20,482 and 3/4 level that I posted also in Top Steps live stream. So then the market rallies up a little bit further, fails at 509, doesn't go to the 538 level, and falls out of bed precipitously and smashes everybody that wants to go long. and goes into a messy consolidation. I want to talk a little bit briefly before we have the CPI number, or PPI number, I apologize. I watch a lot of live streamers that pretend they know what they're talking about. Some of them sell courses and books and whatever. And one of the observations I have is when they try to look at the market, when the market's not predisposed to do anything, and what do I mean by that? You hear the terms power hour, the last hour trading, whatnot. If you ever see a market that has big news impact drivers like the PPI, CPI number, like we have here on Thursday, yesterday, and Friday today, you don't want to be trading the last hour on that, okay? And you also don't want to see it happen when you do this. When you have the market trade above a high and fail and create a low in a lower low, come back into the range, then consolidate going into the last hour of the day. When you have that, you've already done two things. Number one, you've created the high and the low of the day, and you've marked the last portion of the PM session's range. So it's not going to make a lower low than this, and it's not going to make a higher high than this. It's going to consolidate back and forth. And you're going to waste your time sitting there looking at live streamers hoping it's going to do something when it's not going to do anything at all, because it's being strangled. It's being held in place. It's in a holding pattern because it's going to build overnight sentiment. Overnight sentiment is here. Here's 7 o'clock. That's when the market's allowed to trade. See that? That's exactly what I told you to look at. Start following it at 650. 650 is there. The market creates displacement, running what? The buy side. And then it consolidates all the way through until 10 minutes after 11. And then we have what? After taking liquidity here, then it dumps. And now we're ranging ahead of the PPI number, which is where we're at now. So I'm going to use this yeah, we'll just stay with the 1 minute chart. I don't need to do anything else. It's pounding me. We have one minute left, and then the PPI will be in here tearing people's faces off. So you want to look at 15-minute time frame to get a lay of the land, meaning where are the liquidity points, stops, where is it smooth, where is it jagged, where has it been made jagged. Sticking to the long-term bias, yeah, I'm not ruling out the likelihood of it wanting to go higher, but it might want to smash down lower again, like yesterday before the CPI number came out. It went down to go up, but if we didn't have PPI this morning, this would have kept on going and would have went to 538 and higher yesterday, and we'd probably be opening up above 600s today. But because we have the PPI number here in 10 seconds, don't trade this, folks, because it's going to hurt you if you try. So already, do you want to trade that? Try to put a demo trade on right now. You can't. Trading view always locks up. Which is funny. It's interesting, isn't it? So they left smooth lows here. Notice that. They went down into yesterday's first presented fair value gap, but they left that really too smooth. Remember, there's a lot of times that the market's going to look like it's giving you an opportunity, but that opportunity is a cleverly disguised impossibility. And knowing when those conditions are being laid before you as a snare, as a trap, to entice you to do something that you're probably not going to be successful in finding profits or avoiding larger losses than you're willing to assume. knowing that condition ahead of time is paramount to learning how to trade with good entries or tight stop losses, because you can make all the money doing that, but then lose your mind trading in a day like this when the report is due out and you don't know what the economic calendar is suggesting. We're not suggesting it's what's going to happen at 8:30. You're investing your money without understanding the risks. You have no idea what you're doing. So it's remarkable seeing how many people out here pretending to be teachers and mentors, and they don't even refer or confer with the calendar with their students. It's just a testimony that people out here should not be teaching. My landscapers are here, so I apologize if you end up hearing that. It's nothing I can do about that. Sorry. As a reminder, whenever I'm looking at a PD array, or if I'm looking at a reason to get into a trade, I'm looking at not just one thing. I'm not looking at just one specific PD array, not one fair value gap. I'm not looking at one order block. I'm looking at three. I'm looking at three things. Three things have to agree. And I'm not even referring to time and price either. I'm talking about three things technically that's inside a idea behind me taking an entry. If it's just me simply seeing an order block or a fair value gap and I want to be long, and buying a down closed candle by in and of itself is not an order block, just as much as you might want to refer to an area where it consolidates and then rallies up. That's not a demand zone. Okay, if you want to look at demand zones and supply zones, I don't do that. But there are things that have to be linked in close proximity to that very PD array. So if I'm trading a fair value gap, it's going to be inside of a larger order block, which is after taking a pool of liquidity. And if I'm bullish, it should be below a previous low. So now I'm absorbing, like smart money, that sell side liquidity. So I'm accumulating the sell stops for the express purposes of using it as a mechanism to be net long. So I'm looking for three things to agree. And that's why it's important that you just don't listen to somebody make a video about, here's an order block, ICT order block. Here, find the right fair value gap. I found the secret to ICT fair value gaps. You don't even know what you're talking about. But if you look at the patterns that I show in my executions, not patterns, if you look at the points of entries, go through your charts and study, you'll see that it's not just that fair value gap I'm entering on. It's not just that order block. It's not just that breaker that I'm using. There's two other things there at minimum. And if you don't have those three things for your entry, chances are you have a very low probability entry. And yet it goes along the same lines of these jacklegs that will watch what I'm doing, or they'll watch a video, or they'll watch me annotate something, and it goes through it, not realizing that the fact that I'm looking at that is a measure of the real interest for the market to want to reprice higher or lower. I'm not always going inside of a fair value gap just because I'm highlighting that range. I'm anticipating it behaving a specific way, having a characteristic behind it. And there's other things that's along the same premise that makes me bullish or bearish, and I'm waiting for those things to come in agreement with at the same time. So your entry mechanism has to have, if it's going to be high probability, it needs to, number one, have the signatures that the market is in fact not being intervened. There's precision, there's elements that it's booking price with the bodies inside of the PDA raise. The wicks can color outside the lines, that's always a given. But are the bodies still supporting the narrative that the price should be going higher or lower? But then you're also looking for two other contributing factors to why that price entry should be even considered at all. A fair value gap inside of a bullish breaker after it's taken a smaller short-term swing low out. What's below the swing low? Sell side. You're inside of a bullish breaker and you're inside of a fair value gap. So you have three things there that makes that an enormous probability for price not to go lower, but in fact to go higher. So there's a lot of blending of things that has to happen. That's why it's important. You have to start with just one PD array. Just start with one of them. And then when you go through your annotations and you back test, you want to be able to see, excuse me, you want to be able to see if there's a confluence or an agreement with other PD arrays that would be similar in the idea that would send price higher or lower at that general area in proximity. So notice that we opened, traded down into yesterday's first presented fair value gap. Excuse me. After trading in yesterday's first presented fair value gap, leaving the relative equal lows here, it rallies up to the low of that daily SIBI. Notice it hit that there, and then look at the reaction. Why would price want to go from here and go higher without taking out the sell side first? Even if it wants to go higher, why would it want to do that? I would not use, like, for instance, like consequent encouragement here. Like if this would have traded down below and came out and created this scenario, I would be trying to go long inside consequent encouragement here, but it has not done that. It's left the sell side. So it's more likely that the market will want to come down here and disturb all this. This is unfinished business here. This is on a high impact news driver, no less. It drops down and stops in yesterday's perfectly to the low of yesterday's first presented fair value gap. What's the price of the low on the fair value gap yesterday? It's 20,364.75. What's the low of this candle? You're looking up here. $365 even. So it's one tick away from the low. So why wasn't the buying and selling pressure sufficient enough in there to at least upset these lows? Because this is all enticing people to do what? Chase it. Which direction? Long. So if that's the case, if they want to be going long, where would they put their protected sell stops? Because if you're long, you're going to use a sell stop to protect that position. Where would they dogpile all that sell side liquidity? Right below here. Thanks for playing. Now in this price run here, if we take that from here, you can hear my puppy snoring. Scalp. So we're going to look at this price range in here. And no, we're not going to do that. Alright, and then what we'll do is we'll look at it on a 15-second chart. Alright. So now watch. On a 15-second chart, it trades up into the low of the daily SIBI and then creates one more high into it, and then it gives up the ghost and trades down. This high is met by a higher high there. The low in between in here is your breaker. This candlestick trades up into it. This candlestick trades up into it. So this breaker is being capitalized. You can short, anticipate what? The sell side annotated. The market breaks down. In every single instance that it creates an up close candle, you want to measure this. Watch. This is your breaker. Right here. So let's annotate that first. Volume imbalance, it redelivers to that and to the breaker low. It's the low candle, down close candle, prior to the run up that takes out the high. That's your breaker. It is not this. It's this. So market trades up to it, delivers perfect, breaks lower, and then if you're right, if you anticipate the market doing what? Going lower to sell side, which is below that low here, and that's your yesterday's first presented fair value gap. And relative equal lows that it formed this morning, all this in here. That's what this drop in here was. Watch how you can track institutional order flow. You do not need level 2 data. Okay? You don't need any of that DOM stuff. You don't need volume profile. You don't need VWAP. You don't need any of that stuff. Every up close candle is a delimiter for where price should not go above. So here's an up close candle. The market leaves it and goes below this candlestick's opening price, which is the change in the state of delivery. That means that the market can trade inside of this range, full range. So it looks like this. Actually, I'll get to that candle in a second. There. So inside that area there, you're going to see the order block doing its job. The algorithm's referring back to this candlestick's opening price. So it can trade inside that range like it does here, but it does not take out its high. The market goes up into it. The bodies are respecting the body of that candlestick. Look at the green candle's body here to that candle, that one. Goes up, but then stops. And then we see the same thing happening here. I apologize. You're going to hear that. The guys running the mowers in the back. I'm in my living room, so my wife isn't with me right now. She's out and about, so same thing here. The market trades down below. So it validates what? That's the change in the state of delivery, the opening price, and the candle opens here and then quickly what? Leaves it. So order flow is bearish. All the green candles or up close candles are doing what? They're limiting the delivery on price to the upside, keeping everything focused on sell side delivery. Sell side delivery continues until sell side liquidity is engaged, which is that low down here, which it trades down to here, which I was telling you up here when it was doing it. Go back and watch the live stream, you'll see that's the case, and it's the truth. And the market does what? It starts to displace, stays heavy, and then the same thing, we see up close candle, so we can still track order flow, no depth of market, we're not looking at order ladders, I'm not looking at market map, what's it called, book map. We don't need any of that stuff. None of that stuff is required. Everything in the open, high, low, and close, and time. So here's that candlestick here. Watch. Here's your order block. The candle can do what? Can trade inside the range. Does it leave the upper portion open? Yes. And it rolls out. This candlestick does the same thing here. This change in the state of delivery. That opening price, that's your trigger, same method. Get that off. Every price run, when you're looking at price rallying higher or lower, this is what you're supposed to be doing. You're just going to reverse it when it's going higher. Every down close candle should be performing like this. We have a change in state of delivery here. The candle opens up on this one here, trades up a little bit, but stays what? Inside the range of this candlestick. And it does what? It stays in the lower half. It does not trade or traverse to the other half or up part of it. Stops dead in its tracks. breaks lower. Same thing here. I'm not going to keep painting them out. This is just a small one. And then finally, it just does the same thing. Delivers down to the sell side I annotated. Okay, so what am I saying here? High frequency trading algorithms are entering on this low. They're trading above the high here. Then when it breaks down, they're trading short here. They're trading short in here. They're trading short right on that candle's opening. And when it starts to do this, they cannot enter anymore. Why? Because you're leaving the premium aspect of that range that they're firing on. That's half of the move between this low and that high, which is the reason why when I'm pyramiding, I'm only pyramiding when I'm short in the upper half. And once it starts to displace like this, it's breaching the lower half. So half of that range from where you're targeting and where you're seeing the beginning or inception of the move, you have to define premium to discount. I saw a young man on YouTube talking about how there's no premium and discount. Again, stop listening to these 20-year-olds. They literally don't know what they're talking about. Okay, they find something in market replay, or they've done something on a flip of a coin, and you think they now have a new science. Only short in premium, only pyramid when you're in premium, and when it enters the discount of a short sell side delivery, know what it's reaching for. When it gets it, get out. Follow order flow, as I'm teaching you here. Down here, the high frequency trading algorithms are not entering on this. They're seeing that this is the last one prior to that low being taken. So they're going to anticipate what? Speed. They're going to anticipate speed and delivery. And it means you see this. They don't want to let these individuals off the hook, so the algorithm quickly rebooks down there as fast as it can. And that's real order flow. That's real order flow. There's no depth of market over here. There's no volume profile required, no VWAP, no point of control, no initial balance high, no initial balance low, no overnight inventory. All that stuff is grade A bullshit. It's bullshit, okay? It makes it sound like you know what you're talking about. But if it worked, people would be constantly doing what I'm doing, outlining it to the tick, and you're not seeing that. But they'll explain it. Here's how it worked over here. No, explain it real time. Real time, flawlessly, consistently, over and over and over again. Then you might have somebody that can listen to you and subscribe to your bullshit. But until then, it's all nonsense. So anyway, I am not feeling well. So I'm going to use this as an exit to get out of here and go get some rest. Be careful today. It's Friday. There's no reason for you to go out here and try to prove yourself. There's no reason for you to try to make money. If you haven't made money on the day or the week, just be content with what you have. Lick your wounds if it's a loss. Cheerlead yourself. If it's a win, be content. There's nothing exciting about today. Just relax. And if you are going to watch it, just tape read it. Until I talk to you next time, be safe.